Well, hello, YouTube. It's a big day here at the channel. We have Mike Khouw visiting with us today. Now, Mike is an option bro, a big time option bro, and a volatility trader. Of course, you guys might know him as a CNBC contributor. Mike, I believe that you've introduced a whole generation of option traders to the put spread risk reversal and other more advanced strategies, and I always appreciated that. Thanks for being here, Mike. Could you tell us a little bit about your new gig at YieldMax? Are you having fun? What's your title? What's your responsibilities?
Yeah, so I just started with these guys officially only about a week ago. So you're one of the first people to speak to me since I joined up with them. My title is YieldMax Strategist. The way I got in touch with these guys, or maybe more accurately, they got in touch with me. I happened to be talking about one of the YieldMax products on a video. I was being asked about it. In that case, it was Misty, which is the single stock call overwriting on MicroStrategy, now known as Strategy. And their head trader, Scott Snyder, well, actually their head of trading is Jay Patricelli, and then also Scott Snyder reached out to me after that conversation and said, hey, we spend a lot of time trying to explain these products to people, and it seems like you understand the underpinning strategies pretty well. What do you think about coming to join us to do that? And that's essentially what I'm doing. So I talk to them about strategy, and I talk to investors about strategy, and it's all about options. And you combine the fact that I love to talk about options and I love to hear myself talk. It's a pretty good fit.
You should get a YouTube station. I mean, you already have one, but speaking of that, I never miss your Monday and Wednesday show. That's some of the best stuff. And I was watching the day that you fielded the question about Misty. So yeah, I was so excited when you started talking about YieldMax. Well, today I wanted to kind of start with SLTY because it's a new fund that came out today. Maybe you could tell people a little bit about SLTY, the strategy it's doing, and then I have a follow-up question or two for you.
Yeah, sure. So as most will know, I mean, the bulk of YieldMax strategies are, as the name would imply, focused on trying to generate yield, typically by selling options premiums. The most common way to do that most people are probably familiar with is something called a buy right. You buy the underlying stock, you sell calls against it, and you have some exposure up to the short call strike for the call that for the stock that you own, and then you generate some premiums, hopefully recurrently, by systematically selling some upside calls against it. Of course, it is possible to construct strategies that don't necessarily have a long delta tilt, though, like that strategy does. Ulti is one of the other more diversified funds in the YieldMax suite of ETF products that can do a multitude of things when it comes to trading options, but will generally have a long bias. And Salty is a structure that has more of a bearish bias, right? So you can do structures where you look to collect options premiums, where you have no view on the underlying, a bullish view on the underlying, a bearish view on the underlying. And YieldMax's approach is to ensure that there's enough of within the product suite that people can express the directional view that they have, if they have one, whether it's on an individual stock or on the markets in general, and also collect premium and have somebody do that for them. So that's the underpinning thesis there.
Well, this follow-up question came from a longtime viewer and a friend of mine. This is Tom. He wanted to know, what do you think is the portfolio use case for SLTY, for Salty?
Well, I think, first of all, for any one of the strategies, the first thing that anybody should contemplate is, what is my view on the underlying asset or assets, depending on which of these products you're looking at, and just making sure you're in alignment with that. So an example is, just from the single stock world, you can imagine that there's a Tesla overwriting, and then there's also a bearish one. That's crash. You can have a bullish view on, say, Bitcoin and strategy, or you could have winter, right? So the first thing you always want to do is just make sure that the investment objective of the fund you're looking at is in alignment with your own market view for the underlying assets. So the appropriate approach, if you're thinking about Salty in isolation is that you're not going to be bullish on equities in the general sense if that's the one fund that you're taking a look at. You still are looking to harvest some premium and take advantage of what the options market might provide for you, but you're doing so with more of a bearish view. So it is possible, I should say, because these strategies are not the inverse of one another. So, for example, if you have a buy right in Tesla, and then you also have crash on, they're not just taking the opposite sides of the same trade. So there are circumstances that can arise where, depending on what the volatility markets are providing for you, you can put some of these structures together to mitigate some of the delta view, and still have a perspective on premium. So they can be complementary. They're not the opposite of one another. I guess that's one way I would suggest it. But because they're not the opposite, one shouldn't necessarily think of one as the perfect hedge for the other either, right? Just think of the overall investment thesis and the overall investment objective, and that's probably the best place to begin.
So would it be fair to say that this would maybe be a tactical play as opposed to, you aren't going to put it in you aren't going to go 60% SPY, 40% salty?
I think I tend to think of any bearish view on equities as tactical because over the long run, stocks rise. And they rise for a host of reasons. The economy in general grows, sometimes more quickly than at other times, but let's just say that GDP grows at 3%. And let's, further add to that by saying that the best performing companies that are publicly traded, so if we're looking at the S&P 500 or we're looking at the Russell 1000, those companies typically grow faster than the economy overall does. That makes sense because those indices are basically a basket of the economy's biggest winners. That's going to be whatever the NVIDIA of the day is. That's what's going to be the biggest in those things. So their top line growth is faster than the economy. And as they improve their efficiency, typically their adjusted EPS grows even faster than that. So if GDP is growing at 3%, the top line is growing at 6%, and adjusted EPS is growing at 7 or 8%, this is going to grow over time. And then, of course, you just have the fact that inflation erodes the value of a dollar. So all else equal, those assets are going to appreciate in dollar terms.
Absolutely. Let me ask you a follow-up on the tactical SLTY. This is also from Tom. So why not, if you thought the market was going to go down, why not just sell a little bit of stock? I mean, could you do that as opposed to investing in a fund that sells premium? Is there an advantage to selling premium versus selling a little bit of stock to pay yourself the same amount of money?
Well, if you sell your stock, you're not paying yourself your money. You're just basically moving it from one pocket to the other. I mean, if I have $1 million worth of stock and I sell $400,000 worth of it, well, I still have $1 million, assuming the stock market hasn't moved. So we're just thinking instantaneously. Now I have $600,000 worth of stock and $400,000 worth of cash. If you have something like Salty, which is expected to have a positive carry, that's a different thing. They don't pay a big dividend, but SPY pays a dividend, right? So if dividends in the underlying asset are high, then there's probably some negative carry associated with being short that asset for a considerable period of time. So, the idea here is to have a more bearish perspective, but still have a positive carry. I think that's the way that people should be thinking about this. So it's a very different thing. In the same way that a buy right or a covered call is different than just simply owning the underlying stock, so too Salty is a different perspective than just being short stock.
Yeah, good point. I really like the build, the initial build of Salty. I realize that's probably Jay and Scott's call, but I'm sure you saw it too or concur. But it looks like they've done reverse callers on the entire portfolio. And I thought that was cool because you being short stock, of course, you subject yourself to unlimited risk, but not if you have a caller on.
Yeah, so I think this is an important thing, and that is that these strategies allow the managers to exercise some discretion and manage risk. If all you did was say sell strangles, or you sold straddles and you sold them straddles or strangles and you adjusted your strikes so that they had a more bearish tilt or a more bullish one, you still would be subject to considerable risk to the downside and unlimited risk to the upside. This is in theory, of course, because we're talking about a portfolio of stocks and they're not all going to go to infinity overnight, but let's just acknowledge that you can have material upside risk. Well, if you're selling call spreads, for example, and selling put spreads, you're defining your risk. So you can still have positive carry, maybe not as much as you would by taking unlimited risk, but risk management's an important part of managing assets. So
yeah,
that obviously is critical.
Yeah, well, I think we've covered SLTY pretty good. Salty. If anyone has any questions, put them about Salty that we missed. Put it in the comments, and we'll have some time for viewer questions here in a little bit. Okay, for the next part of this meeting, I wanted to talk about kind of like a MythBuster segment, but on YieldMax and on options. I wanted to talk about some popular narratives out there and see what your opinion was and if you could bust the myth or not. The first one I want to start with is the media narrative. And this happened about a year and a half ago, but it involved you. It was on Options Action. And it was when it was actually another fund also managed by Tidal or also sub-advised by Tidal. But they were talking. It's when these first funds came out, and none of the people on the desk liked the idea. I forget what Melissa Lee said, but I'll never forget. Dan Nathan said these things look like an accident waiting to happen. And then Tim Seymour said it was like picking up nickels in front of a steamroller. And I vehemently disagreed with Tim's take. And that's when I started making YouTube videos because I thought we could educate people. The fund in question was selling 60 delta put options every day. That's not picking up nickels. Picking up nickels would be selling a 5 delta or 1 delta put option, correct? I was going to say that media narrative, do you think that's still out there? And are you aware of that?
Well, first of all, nickels in front of a steamroller, I think actually the earliest version of that metaphor that I heard was nickels in front of a train. Okay. Nickels in front of a steamroller is actually, that sounds a little bit more appealing because steamrollers don't move that fast. Trains do. What that metaphor is, it's been applied in finance for as long as I've been in finance, which dates to the 1990s in my case, but I'm sure it existed actually even before I entered it. It's not like the lexicon of finance began the day I started trading. But, that's often applied to investment strategies and products where an investor is going to be collecting, whether it's modest premiums or interest coupons, any sort of positive carry trade where there's a possibility of a substantial loss. I mean, I would argue that probably the best example was some of the CDS that was going on at AIG pre-GFC, right? So that was when they were insuring some of the, shall we call them creative bond products that were tied to the housing crisis. And they were charging incredibly small premiums essentially to trade those swaps. So they were taking on a lot of risk and collecting a little premium. So, the thing that should matter to folks when you think about this is not whether for any premium you collect, it's small relative to the worst possible case loss that something might take, but it's a measure of your expected returns over time. Now, whether something has any risk, by the way, there's a big misconception about this. People think of U.S. Treasuries as being risk-free. And U.S. Treasuries, what do? You loan your money to the government, and they pay you a modest amount of interest and then eventually return your capital to you. Now, if you had bought long-term U.S. Treasuries in August of 2020, by late 2023, your total return would be down 50%. That does not seem risk-free to me at all. Bank of America lost huge amounts of money because they had a lot of duration in their book. So, the important point that I would make is there are positive carry trades that are good and there are positive trades that are bad. Two things really affect this. Number one, how much you're being paid. And the other is essentially how much duration you're taking, or when you actually get your capital back. If you get your capital back faster, so the distributions are coming more regularly, that reduces your risk. And if the premiums you receive are substantially larger, in many cases, that's going to reduce your risk. And then, of course, there's the risk of the underlying asset, which matters as well. But I don't think it's nickels in front of a steamroller or a train. I'm not saying that those things don't exist in finance. They do, but that's not how I would characterize these.
Well, the guys on my channel are option traders mainly. And I think, this is my opinion, I think that if you sold a 0 DTE 5 delta put every day, that's what or a 1 delta put, because you would win most of the time, little tiny amounts, but you would have a few spectacular losses. Is that the same thing as what we're talking about?
Well, what's interesting, if you sell a 60 delta 0 DTE put on SPX, for example, the amount of extrinsic premium you're collecting is, probably not huge. S&P is not generally very volatile. Implied volatility is not generally very high, but a 60 delta put is in the money. So that means that you have some exposure to equities. Over any 30-day period, the S&P is up nearly 60% of the time. So if you're making bullish bets on the S&P day after day after day, in general, you're going to win more often than you lose. If you're collecting a little extra premium as you do that, that gives you a little bit of a tailwind. When would this trade have really felt like it wasn't such a great do? Well, remember the V bottom, we had that Liberation Day sell-off and everything that followed. And then we had a V bottom when people said, oh, the tariffs aren't going to be as bad as we thought. And we had a trough to peak rally that was one of the sharpest I've ever seen. Well, in that case, you would have rather just be long equities, right? That would have been better. If you had been selling 1 delta puts, you would have collected nothing. If you're selling 60 delta puts, well, you collected a little bit of extrinsic premium and you had long market exposure, which let's be honest, most of us have long market exposure. Not too many people have a 401k that's short stocks on balance, right? That's just not the way it works. So I don't think those things are comparable. A 1 delta put versus a 60 delta put. 60 delta put has market exposure. The 1 delta put only has market exposure when you don't want it in a disaster.
Exactly. Well, thanks for clearing that up. Okay, well, here's another narrative going on, and this is more of in the retail trading community, and it's not so bad anymore, but it's still out there. There's a narrative that just mathematically these things are going to zero, and also that they're a Ponzi scheme. So that's a similar question. Could you maybe give us some math behind it or something?
Sure. So a Ponzi scheme? No. A Ponzi scheme is a specific. Bernie Madoff conducted a Ponzi scheme. What was he doing? He claimed to be trading options, but he wasn't. He was taking investor capital, and then he was taking later investors' capital and giving that to earlier investors. That's not what we're doing here. And in fact, not only is that kind of a false narrative, it's demonstrably false, because the custodian banks publish the fund holdings every day. These are fully transparent. You can see what's in them. And it's definitely not that. It's not taking money from Peter to pay Paul. That's not what's going on here. So that's definitely not what's happening. I think the reason that people think this is because they might see, well, first of all, consider that when anybody looks at a security, what's the very first thing almost anybody, including me, does? And I've done deep dive investing, but you pull up a stock chart of it. And in many cases, if you pull up a chart of something and you see that the price of that has declined over time, immediately you're thinking, okay, this is inevitably going to trend straight to zero. And there are exchange traded products that have what we call a roll cost, which means that the underpinning strategy has a negative carry, so that if you put money into it, it costs you to stay in that trade over the course of time. And eventually, does it get to zero? It's ever diminishing. So it sort of converges to zero, but that's not what we're talking about here. In the case of the YieldMax products, there are distributions taking place, very big distributions. So those distributions can come in the form of options premium. There's also a distribution that comes from gains as well. So if you're always giving people a portion of their gains and you're always giving them a portion of the options premium, and maybe in some cases, if you're making a distribution that is larger than one or both of those, then there's going to be some return of capital as well. That can happen. Then you might see that the value of the fund has gone down, but the total return to the investor has not. If you put $100 in, and then after 1 month you receive, let's just for the sake of argument, you get a distribution of 7%, and the value of the fund is now 98 cents on the dollar. Well, you came out ahead, right?
Yeah.
You came out well ahead, but you're going to see that chart. And I think that's where people get this misconception. And the other thing is that return of capital is a characterization of a distribution. So what I mean by that is it has certain tax implications, but a return of capital is not taxed. I mean, all else equal, if I get a distribution, I'd rather it's characterized that way. There's nothing, you don't get something for nothing. It lowers your basis in the underlying fund. But, there are a lot of reasons why you look at these distributions, you really have to take a look at the total return, and the total return is positive.
Well, I think here's where I think the confusion comes from, and maybe you can speak about the creation and redemption process a little bit, but I think some people think if new people don't keep buying these ETFs, kind of as if they were a stock, they won't have enough money to sell premium with or whatever. But these don't really trade on supply and demand, right? They just print new shares, right? Or destroy shares.
So, I mean, the first thing I would say is that the underpinning strategy does not depend on new capital flowing into it. So that's the first point I would make. However, and this is an important thing to think about, there is no fund that can only make distributions and service people's redemptions and not have any new capital coming into it and live forever. I mean, because some people will close their positions because they're buying a house or they're retiring or whatever, you're paying out any dividends you receive, any interest income you receive, any options premium you receive, you're paying out some gains, and then you might periodically be returning some other capital as well. Eventually, it's not that the fund can't continue. The manager might not want to continue doing it because you'd say this is just not an economic exercise, but it doesn't depend on new money coming in to do the strategy. With whatever money is there, whether it's a large amount or a small amount, and that amount changes day to day. It changes because people do buy and sell, because there are creates and redeems, and because the underlying assets rise and fall. If I have $1 million worth of NVIDIA and it becomes $2 million worth of NVIDIA, I don't need a creation to have more assets in the fund. And if MicroStrategy goes down by 20, 30%, the fund's going to have less in it unless somebody else invests more. That has nothing to do with the manager. That's just what the underlying stocks have done.
Well, I've heard before that there's kind of a level, maybe 30, 50 million, 100 million assets under management, that when a fund gets there, it is economically viable. And I know it depends on the company, but I think that's something else investors can watch for is the AUM.
Yeah, that's true. And the bigger the company, the lower that number is, because there's a lot of synergies, right? So in the case of YieldMax, which is, I don't know what the assets are as of this exact moment. We'll pick a round number, call it 19 billion. And then, Title, which manages these funds and many others. So there's synergies related to that. So, in terms of operations and, trading and compliance, those are very expensive things to conduct in financial services. But there's more than $40 billion being run in 240 plus funds within the overall financial entity. So that gives you a lot of scale, and the benefits of scale, pass through to the individual funds, and they become sustainable at smaller levels. Nevertheless, they become too small, then it doesn't really benefit the fund manager to continue it. And if there isn't a huge interest in it, why would one continue to do it? I mean, I used to like a cereal called Product 19. And I went to the grocery store one day and they didn't have it anymore. Was the cereal no good? There weren't enough people that wanted to buy it, apparently. So that was that. I mean, if it's not to people's taste, people decide they don't care about MicroStrategy one of these days or some other stock, and they'd rather trade it on something else. I think the valuable thing that a manager can do is make sure that they are focusing on what interests investors, not what happens to interest them.
Well, and this predates your relationship with YieldMax and Jay and the crew, but since I've been covering their high yield funds, they've only had one shutdown that I know of that they sub-advised, and they were doing ratio diagonals on the TLT, straddle strangle swaps on the TLT. I love the strategy, but the TLT didn't have very good volatility. It was a long volatility strategy. The volatility didn't materialize and they pulled the plug. But other than that, they have a pretty good record, in my opinion. I understand that an industry average, maybe 1 out of every 4 ETF shut down in a year's time or something. But I think YieldMax is easily exceeding that number.
Yeah, I mean, I've personally been the PM of an ETF that shut down because it just wasn't economic to do it. It was a painful and expensive exercise. Our performance was good. Our first year, we outperformed the S&P, and we were basically long mega cap equities trading around events. But when we added up the costs and the revenues, it was spending dollars to make sense. That's not something you want to continue doing. And so after doing it for 2 years, we decided not to. And actually, that's one of the reasons why I like teaming up with these guys, because that scale, it has real benefits. I mean, you think about a huge outfit like BlackRock. I mean, they can launch ETFs and they can come and they can go. No one's going to criticize BlackRock if they close an ETF, and I'm sure many have. But they benefit from their size and scale, and YieldMax and the title team do too.
Yeah, that's a good point. Good point. Okay, so now on to dispelling some narratives. There's another option bro out there in the world named Ben Eifert, and I believe he's a Bay Area guy, and I would imagine you know him. He just recently was in the papers, on the internet, I don't know what you call it, talking about that he didn't think it was a good idea to sell volatility indiscriminately, to sell it systematically. He thought that the volatility trade, covered calls in other words, were good for tactics, or maybe when, volatility was high and you thought it was coming down or whatever. But he thought, he said recently that the indiscriminate selling of vol was artificially compressing volatility out there in the market. Would you have a comment on that?
So there's more than one question in there. So I do know who Ben Eifert is. I've actually spoken to him on the phone. It's been several years. I was still living in Austin.
Yeah.
The last time I spoke to him. So it's been quite a few years. A former colleague of mine was subsequently a colleague of his. Now a manager at Neuberger Berman, but that guy was a former D.E. Shaw trader, and he described Ben as one of the smartest options guys he'd ever met. And that comes as high praise from somebody who worked at D.E. Shaw. So let's put it that way. So let's address whether it makes sense to sell vol all the time, systematically and indiscriminately. Some strategies will do better during certain periods, and it will do worse during other periods. If you are in a buy right covered call strategy, you're long delta. It's synthetically equivalent to being short puts. That can be a very good investment strategy. It's not a great one when the market rolls over, though. You get a market correction, or if you get a bear market, heaven forbid, it happens, though. I've seen a couple. It's not going to do well. Neither will anything that's long stocked, for that matter, do particularly well. The second part of that, though, is systematically and indiscriminately. And that actually I would take some issue with, because while the YieldMax strategies are looking to collect premium systematically, they're not indiscriminate in the underlying strategies that they use to do that. Let me give you some examples. So if all you did was buy a stock, sell a call, wait for expiration, and then roll it again, that's indiscriminate, and it's also systematic. A monkey could do it, right? Just sell, call, wait, sell, call, and wait. But that's not what happens. If YieldMax sells calls and the underlying stock drops and the value of those calls diminishes to something very small, maybe a nickel, as we were talking about earlier, the traders are going to cover those.
Sure.
And while they are going to look for opportunities to sell more premium, if they're concerned about a V-shaped bottom, they can also own some upside calls. So they might sell call spreads instead of just naked calls. That diminishes how much premium you collect at that moment, but it also reduces the risk of getting wrong-sided if you get a V-shaped bottom and a quick bounce. So, is it true that being long delta, short vol is painful in downdraft markets? Yes. Will that affect these strategies? Well, the long ones, certainly it will. But the underpinning strategies here are not indiscriminate. And in Ulti's case and in Salty's case, they have a lot more flexibility about the strategies that they can use within, the fund prospectus. You can read about that. And so consequently, that creativity means that the traders, and there's some experienced options traders here, Scott Snyder and some of these other guys, Scott's been in the business longer than I have. I got into the late 90s. I think he, preceded me by several years. So these are not novices. They've seen different markets and they can adapt to them, within the confines of the strategy, of course, but they have some flexibility there.
Very good. Well, we're going to dispel two more quick myths, or maybe myths. We'll see. And then we're going to get on to some viewer questions. We have some good ones coming in. Now, these are narratives that I started. So, but be that as it may, let's talk about option strategy construction. Some funds will use a combo to get long exposure to the stock, and then they'll sell covered calls on the combo. Some funds might use a deep in the money option, but anyway, and then others use the stock. Which one's better, the combo or using the stock, or does it make any difference?
It can make a difference. Now, let's bear in mind that because of the 40 Act, certain funds are restricted in the way they can implement a strategy. So the single stock strategies cannot, due to the 40 Act, it creates concentration problems. You can't have a fund, an exchange traded fund, which is essentially regulated by the 40 Act, that has all of its assets in the underlying stock. So a combination of options gives you a proxy that behaves a lot like the stock without actually having an outsized position in the stock. Now, for those who are saying, well, when I buy a combo or synthetic stock, so for those who don't know, if I buy a call and sell a put of the same strike and same expiration, I'm synthetically long the underlying. And the price of that structure is going to vary based on what we call the cost of carry. What goes into the cost of carry? Really two things. One is the prevailing interest rate, and the other is dividends, if any. So if a stock becomes hard to borrow, so there's a negative rate, that can also play into this. Now, because of the ability of market makers to arbitrage, these trade pretty tight. If you decide to buy synthetic stock by buying a call and selling a put instead of trading the underlying stock itself, you're not going to pay a huge premium relative to the value you get or pay when you do that. And the benefit is if you buy a forward in this way and you support that by owning treasuries, the treasuries are going to be paying you some rate of interest, right? So because you can't have an arbitrage, the forward's going to trade a little bit higher in higher interest rate environments and a little bit lower in lower interest rate environments. But that cash balance does give you some flexibility. So if you're trying to roll calls that were out of the money and now they're in the money, you actually have a pool of cash that you wouldn't if you actually held the stock.
Yeah.
To manipulate the other options position. So it kind of cuts both ways. Now, if the stock dividend increases and you had a really long combo on, then you could have a problem. But if you look at this, you're going to see that in general, you're not talking about combos that go out 10 years. So it's not like you're taking massive multi-year dividend risk either.
Well, that kind of sets me up for the next narrative that I started. I also am out there saying, and this may not be true, it probably isn't, but I'd like your opinion on it. If interest rates go back to zero, because rho is an input in the Black-Scholes model, or interest rates are an input, that wouldn't it make option premium come down, and wouldn't it have a double effect on these funds? Because these funds hold T-bills, so their T-bills would pay a little less. Not only that, the premium you get for selling covered calls in a lower interest rate market, like let's say interest rates went back to sub 1%, like they were in 2014, 15, and 16. You can look at option selling strategies back then and of the companies that were doing it, and they were making about half of what they're making nowadays. Is that true? Will interest rates kill these?
So for those funds that actually have the synthetic on, it's going to be a push. And the reason it's going to be a push is because it's true, the amount of interest income that you receive on your treasury balances is going to go down, but the cost of the forwards is also going to go down by a like amount. So
True.
for those of who are watching who are saying, what is Rho? Rho is the sensitivity of an options price to changes in the cost of carry, which is, as I said before, both dividends and interest rates. As dividends rise, the value of a call falls and a put increases. And as interest rates rise, the value of a call increases and a put decreases. I would actually, and I personally had pretty large Rho exposure at various times. I remember somewhat painfully, I have to say, that I had a pretty substantial short Rho position on. So if you have a short Rho position, that means as rates go up, you lose money in the 90s. And we had a period there where I think we had, within a very short period of time, it was 5 or 6 consecutive Fed rate hikes. You guys who can get on your Google machines or Chat GPT and find out exactly what those were. But that was a 7-figure bit of pain. Now the thing is that as a dealer and a volatility arbitrageur at the time, and because of downtick rules, we typically wanted to be long stock. So we were typically short Rho as just, and I had maybe $1 billion worth of stock in the book at the time. So if you have $1 billion worth of long stock and rates go up and you have an options position, you're going to be short Rho and it's going to hurt. But there is something that I don't think gets much play. And I think this is some nuance that I think you probably suspect this in the back of your head. When interest rates go very low, then that means yields in general are very low. That means that the demand by investors for corporate earnings yields, which is the inverse of PE, declines. So you have multiple expansions. So in the midst of all of these things, you have stocks going up at a faster rate and you have call premiums coming down.
True.
So is it true that call premiums will decrease? Yes. Will it impact the single stock strategies where we're trading forwards? Not really, because we're trading forwards and there's an offset there. So it's kind of a murky area, but I would say that we're not going back to ZIRP, in my view, zero interest rate policy. Sorry, you shouldn't just throw acronyms out all the time. But I don't think we're going back to zero interest rates. So could we see rates come down? Yes. Is that what some people expect? Maybe a little less this week than they did a week ago after they had the chance to read the FOMC minutes. But we're not going to go back to zero. And so I actually think that we're probably in a pretty good environment for covered call writing. We've also had huge expansion in equity prices. And, at some point, we're probably not going to see 20+% a year in equity appreciation year after year after year. Got to look for it somewhere else.
Yeah, good point. Good point. All right, here's a question from Red Sock here. He says he's sitting on some cash and not happy about the potential of Fed rate cuts. Where would you want to invest with YieldMax? Or you probably can't give specific advice, but could you generally tell us?
Yeah. So I'm not. Everybody should consult their financial advisor if they have one, or their common sense if they have any, I guess. And study and do your intuition. My personal preference is that people take a look at the diversified ones first, unless you happen to have a specific view about one of those underlying stocks. If you have a view about NVIDIA here, NVIDIA is going to be announcing earnings soon, folks. So, and probably a lot of you have exposure to it one way or the other. Even if you just hold SPY, you have a lot of exposure to NVIDIA. So pay attention. But if you're positive on NVIDIA and you like doing covered calls on it, then NVIDIA might be good for you. If you're positive on MicroStrategy, that too might be good for you. But in the general case, if you don't know anything other than generally you want to be long stocks and you like selling covered calls and doing other volatility strategies creatively, then I think things like Alti are probably, that's probably more in line with that investor's objectives.
I myself like GPTY a lot also, but I love the multiple portfolio type offerings that you guys have. LFGYs can be a good one too. All right. Well, the next question comes from my friend Dan. He's saying, how would you compare the risk associated with covered call income ETFs versus other securities or products? Some people say these are high risk, and he's saying he doesn't see it that way, or is he the crazy one?
Well, these are, there are exchange traded products that have greater risk, particularly in a downdraft, to equity prices like levered ETFs. But these are not levered. So, the way to think about it is if the market, if you hold a single stock covered call fund, like any of the ones I just mentioned or any other, and the underlying asset declines by 10%, chances are because you're also collecting some premium, you're probably not going to lose 10%. So you'll probably lose slightly less, but you will lose because you have a long exposure to the underlying asset. You mentioned Chippy. So you have a bunch of semiconductor stocks. If the semis get hit, so too will Chippy get hit. But is it going to lose some multiple of what the semis do? No, that's not the way it works, because it's, these things are not necessarily taking on massive amounts of leverage. Now, one thing I would point out is that because these strategies are targeting, collecting volatility premiums, and because most of the stocks that are most popular with investors, whether it's in these strategies or just in general, tend to have a higher beta, you will see probably more volatility in some of the strategies than you do in the S&P or in Berkshire Hathaway, which is 47% cash. So yeah, I think that those are things to think about, but I wouldn't consider them, insanely risky. No.
All right. Well, we have our first kind of tough question or comment. But John, thank you for this. He said, big distributions mean nothing. Probably he means to him when you're down more than you've received in dividends, kind of like taking money from one pocket and putting into the other. I think the thing maybe people miss is the delta component of these, but maybe you could talk on this.
Yeah, well, I think a really good example of this is, there's the strategy component, and then there's the underlying asset behavior component. I'm actually just going to go on to my trusty Bloomberg here and just take a look at some of the more popular ones and how they have done most recently. So looking at Misty, for example. So over the course of the last year, the price change for Misty is down about 32%. The total returns over the last year, had you simply taken the dividends in and invested them in your checking account or whatever, that's about 80%. And if you'd reinvested them into Misty itself, it's about 92% year on year, right? However, if you happen to have bought Misty back on July 16th, your total returns are negative. Why is that? Well, you don't need to look a whole lot farther than looking at the chart of MicroStrategy back on July 16th. Stock was trading 460-ish, 461. It's 337 now, right? So if you owned Misty, you owned effectively a long position in MicroStrategy, and you were selling covered calls. And selling covered calls can't make up for all of those stock declines. So is it true that you've received a distribution in Misty and that it actually has taken a loss? Yes, because MicroStrategy has gone down. So that's, I think, one of the things that people should not think of these like a bond, where you put $100 in and then you wait some number of years and you get your $100 back. And in the meantime, you collect modest interest in the form of coupons. It is what it is. You own the underlying assets, or in some cases you have more bearish views, like we previously talked about, winter, crash, salty. If you don't have the same bullish view, then that's what's going to happen. And actually, in MicroStrategy's case, it's particularly interesting because MicroStrategy has diverged a little bit from Bitcoin recently. It's kind of underperformed. We normally think of it as a levered play on Bitcoin, but there has been a bit of a divergence. So, I don't know which fund in particular he's talking about, but if the underlying assets are going down, that's not good. You're always rooting in a long strategy for the underlying assets to go up, and you're always rooting in a short strategy for them to go down.
It'd be nice if you could make one of these that didn't have exposure to the delta. So it would be more like a bond. And I guess maybe you could, but that would kill the yield also, right? Or maybe you could talk on that a little bit.
Well, it is possible to do that, to take a more neutral tack. But the issue, as we're pointing out here, is that if you do that, it's probably a little bit more difficult to to get quite the same yield out of it. And the reason is because you still need to have a hedge. For example, if you are going to sell call spreads, so that's how you harvest the upside, and you sell put spreads, and that's how you harvest the downside, and you're trying to limit your risk, that could potentially generate some decent returns. But, unlike a covered call position, the covered call, you don't have to cover any upside. You just collect premium and you use the stock as basically the hedge against the short call. And hopefully you want to be long that stock. Don't do it if you don't want to be. And so are there ways to do it? Sure. There are different ways to get into a positive carry position trading options, but it can be a little bit more complicated. The other thing I would say is it's easy to say that if you hold one of these things and the underlying stocks have been declining. But in general, I would encourage investors, especially investors with a longer term view, not to do that. Don't be agnostic to stocks. If you are going to be taking money out for retirement 20 years from now, you're better off being long stocks. Let's start with that.
Good point. Good point, Mike. All right. This is another question from Red Sox. He's saying he wants to know your thoughts on YieldMax, which was a previous favorite of Jay's, according to him.
Well, I think one of the reasons that this was favored by Jay is one of the reasons why I like some of these other strategies as well. And that is that it takes one of the critical elements that is involved with the single stock ones, which can make very good sense because, look, the single stock strategies are largely stocks that are very popular with investors. If you look at the stocks and the options on them, these are amongst the most heavily traded. MicroStrategy, NVIDIA, Microsoft, all of that. But anybody who's been following the markets for a long time, you've managed money in your life as well. Picking stocks is not an easy thing to do. And you will see that when you take a look at just long-only portfolio managers. Not many of them are beating the S&P 500 year in, year out, decades in a row. So stock picking is a difficult exercise. I think the reason that Jay likes YieldMax is because, at least from the investor's point of view, it takes that out of it. I'm looking at it right now, so I'm taking a look at what the underlying equity exposure is, and we've got Berkshire, Exxon, Gold, Disney, Airbnb, JP Morgan, Snow, Baba, Netflix, Google, Apple. So basically, you're going to have a lot and on. NVIDIA, Coin, Hood. You have exposure to a lot of the biggest mega cap companies. The underpinning stocks are going to track and correlate most likely with the S&P 500 while looking to sell covered calls. So it takes a little bit off of the investor who's not sitting there saying, do I really want to be long NVIDIA going into earnings or not right here? What do I think about what Saylor's most recent comments were? And, they've had a lot of news out lately and it hasn't necessarily been digested that well. So it gives you embedded diversification. It's just one less thing to think about. So if people like these strategies because it makes their life easier to implement a covered call, then a diversified fund is going to be easier still.
I guess diversity is our strength in this case. This one came from another question from my friend Dan. He said, Mike, when you started out in finance, so back to the late 90s, I guess, what did you love about it? And what do you love about it now? And glad you're on the YieldMax team.
Well, thank you for the last part. When I first got into finance, it's funny. I started off as a floor trader on the Philadelphia Stock Exchange. I also was on the American Stock Exchange and the New York Mercantile Exchange. The New York Mercantile Exchange was actually a merger, effectively, of the big New York commodities exchanges. So the Board of Trade and things like when you watch the movie Trading Places and people are running around with colorful jackets, yelling and screaming, I was one of those guys. I wore a trading jacket and I yelled and screamed and was ankle deep in paper at the end. It was a pretty exciting and dynamic place to be. I've tried to describe to my kids what it was that I did for a living. I mentioned this actually to somebody who was quite young recently, and I said, how there was a little bit of hazing that went on the floor, and somebody had grabbed my trading jacket out of the members' coat room and put something on it. And the person I was talking to said, "What's a trading jacket?" They didn't even know. I missed that aspect. You're competing with all of those people down there. All of your competitors are you're shoulder to shoulder with them. They're all in the same place. So it's a really interesting dynamic. You are both friends and enemies with the people who you stand closest to for many hours a day. And, it's like playing sports, I guess. That's probably the closest thing I could compare it to.
Kids nowadays won't even know what a trading floor is. Tell us about your conversion to going off the floor. You seem like an analytical quant type guy. Did you prefer off the floor where you don't have to be shoulder to shoulder with all those guys, or did you like that better?
I liked the floor, but I worked for a quantity firm. So on the Philadelphia Stock Exchange, probably the best known of those companies, which is very big and active today, is Susquehanna Investment Group. Jeff Yaz and the partners that founded that firm, took a real game theory and quantitative approach to options trading, and it wasn't always thus. You have to remember that listed options trading didn't really begin in the United States until 1973, and they only had a handful of calls listed. And it wasn't until 76 or 77 that they actually introduced puts at all. And a lot of the guys that first started trading these things didn't know how to price them. And it wasn't until, people like Myron Scholes and Fisher Black and Robert Merton got together and came up with models for how to value an option that it became more quantity. And so you had this brief window, and I was a part of this, when the best thing to be on the floor was a football player, and then suddenly the best thing to be was a rocket scientist. And I was on the floors when that transition took place. So I was in there with 6'4", former college football players, and right next to them was some guy who had just graduated from MIT, and some people were trading on calculators like this one. Everybody had one of these, an HP12C. This is actually an HP12C Platinum, which you can code a couple more lines of program into it. Everybody had one of those things, but eventually everybody had computers. So by the time we migrated upstairs, it was largely a computer-driven game. It was too fast to be open outcry. And the market could accommodate it. You couldn't have every options trader pushing quotes in the early days. It was just too much bandwidth. But now we measure our latency in microseconds, so it's a different game. They both have their benefits, but I kind of miss the floors,
the camaraderie and everything. Yeah. When I think about the football player option, bro, I'm thinking of the Nigerian brothers. But then when I think about the rocket scientist, I'm thinking about maybe a Jim Carson or somebody like you, or maybe Ben Eifert, somebody that's educated at Stanford and a doctor and has more letters after their name than they know what to do with. So it's definitely evolved.
Yeah, the last firm I worked for, we had more people with PhDs than without them.
Wow. All right, let's see. I think we have some more questions. We're running out of time. We have about 5 minutes left. If you guys have any more questions, put them in the comments. I saw one here. Would you care to make a guess on a target range for the distribution in SLTY?
I actually can't make a guess on the distribution, and that's because today is my first day with visibility into what's in it, and I haven't even during this session had the opportunity to upload it into my own spreadsheets. The guys who traded it, I have a feeling that they know right off the top of their head, but I've been staring at a camera and talking to folks like you today. So my first order of business, this being the first day that it actually has been live and been trading, I'm going to be very curious to see. Actually, let's see what was the volume today. Didn't even see what the volume was. So
I'm going to guess 60. I'm going to guess 60 for an average IV, and I'm going to guess 60 for a distribution range. That's just my guess.
Yeah, that sounds reasonable in terms of volume. I mean, again, it's the first day. It traded a little over 61,000 shares. So yeah, it's early days. And what do we got in here? I'm really excited about this product, I have to say, because, all of us who focused on arbitrage were very interested in the relationships between all of these related but not exactly identical securities. That's what statistical volatility arbitrage is. And I think this is going to be a really interesting one to take a look at. But yeah, I can't hazard a guess on that. I bet you Jay, partially because I'm in front of the camera right now and he isn't. He's probably got a much better look at that. And Scott, of course, he lives and breathes this all day long, along with his multi-person team. So they probably have a good sense of where they're at. But you're going to have to give me a couple hours.
That's fine. That's fine. Let's see what else we have here. Here's from my friend SB Trader. He's saying, what would be a target percentage of a typical portfolio to invest in YieldMax funds? In other words, I tell my friends no more than 10 or 20%. But what would you tell one of your friends?
I think that's very reasonable. The one way to think about this is that I look at this as an asset class of its own. So the covered call strategies are an asset class. Fixed income is an asset class, and this is not necessarily fixed income, but it is an alt, a liquid alt, because you can trade it like stock. So that's nice. I'd like to see people with some just outright exposure to, some of the crypto space and some of the metals and commodities. So, how much is going to be allocated to this is going to depend slightly on someone's time horizon. The more time you have to go to horizon, you might just be long a lot of equity and have, a lot fewer diversifying assets. But, if you are a more mature investor, you have a bigger portfolio, then the allocation, or you're closer to retirement in those cases where people are managing a retirement fund, then the allocation to something like this might actually be slightly higher, and the exposure to outright long equity might be slightly lower.
Well, Steve, who I guess is Red Sox's real name, he's telling you thanks for your perspective and congratulations on your new job. I'm trying to think. I have one last question. So, there's one more thing to dispel, or not. I'm always telling my friends also, the younger you are, probably the less need you have, or the lower your allocation ought to be in covered call funds, or just generally, not even talking about YieldMax, but YieldMax, whatever. But then I think there's more of a use case for them in retirement. Do I have that right or not?
I think you and I are saying the same thing. That's largely what I was just talking about with respect to the equity allocation. I think of this within the equity sleeve as a subset of it, but it is one that's more focused on generating distributions. Whereas if you have a really long horizon, what you're focused on is capital appreciation and growth with the lowest possible tax consequence. Those are the things that are going to give you the best possible return over time. I have a son who's going to be going to college next year. Hopefully, if he does things right, he's going to be out and, employed or doing something, 4 years after, if he doesn't go to graduate school. And, I'm going to tell him to invest aggressively in equities, and not focus on dividends, not focus on distributions, not focus on fixed income, none of that. All of it should be aggressive long equity. Why? Because he's not going to be touching that for close to half a century, right? If you take a look at where your money should have been and you could go back 40 or 50 years, what would you do? I think the answer is pretty straightforward. But as retirement approaches, having a huge amount of duration in a fixed income book or in an equity portfolio, those things become a little bit too risky. You need liquidity, and you can't have huge volatility in the value of your assets, because one thing that, your name's got convexity in it, max convexity. The thing to remember is that any pool of assets that is used to support, whether it's a pension or it's an endowment at a college, where those assets are used regularly and distributions are needed or redemptions are needed regularly to support something else, you need to mute the portfolio, because you are short convexity on those assets. Because otherwise, if the value of the assets declines 50% and you have to withdraw, that's a really painful thing. You don't want that. You need to mute the volatility. You need to increase the distributions. It's just simple math. But if you have a lot of time, then aggressive long equity, I think, is the way to go.
Yeah, my daughter just turned 27 yesterday, and she's all in on growth ETFs, and that's what I told her. And But yeah, I think that's a good thing to do for a young person. Just have a job and be all in on growth, and then worry about this other stuff in a few years.
That's
well, Mike,
right.
we've run out of time today. It's 2:00. I'm trying to be respectful of your time. I'm going to cut this stream loose. Then I want to say thank you to you. So hang out here just a second, Mike. All right, guys, thanks for being here for the stream. Like and subscribe, all that other good stuff. Appreciate all the great questions. You guys did a great job. Thank you so much.